Thank you and good evening to you all. Thank you for joining us again tonight. We thank you for your time. We don't take it for granted. We know it's Thursday evening after work. People have busy schedules, but this is a learning experience for all of us. We have our discussion every Thursday evening, 8 p.m. Central Time, 9 p.m. Eastern Time. We meet together this evening to tackle the topics that actually matter to us as families. And tonight, we have a beautiful topic that actually concerns our children, our young ones, and all of us. And as I can see across on this platform, it looks like most of us are parents. So I believe we're going to have a beautiful night tonight. Myself speaking, my name is IMMACULATE BUSINGYE. I reside in Dallas, Texas. I'm a mother myself. That is why I'm so excited tonight to have you with us. So, and my co-host is going to be Beth NSHIMIYE. She'll have enough time to introduce herself. She's a mom. She's so great. You get to know her as she starts speaking. So we welcome you again. Tonight's discussion is very, very important. And that is why we don't want to waste anyone's time. We'll go ahead and get started. But as always, so as we always have those discussions every Thursday, we start with questions from actually our audience. So before we can start with the main topic for tonight, we'll go back and look at what actually, let me know if you can see my screen. Can you see my screen?
Yes, we are seeing it.
Thank you so much. So I did introduce myself. So tonight, before we get started with the main topic for tonight, we'll try to answer as much as we can the topics that came from our listeners from last time. Again, always we record our discussions so that we can be able to share with other members who are not able to join us when we discuss. Please, if you can, try to mute your mic. If you are speaking, we can actually allow you to open, but do us a favor and mute. So the first question we got from last discussion, someone sent us a question saying, could you clarify which specific conditions are generally covered under chronic, terminal, and critical illness riders? For those ones maybe who didn't join us last time. So maybe for people who are visiting tonight, last time we did tackle different types of life insurance coverages we do have, the living benefits that comes with them. And that's possibly why we did get this particular question. So for people maybe who are not able to join us, we'll go through that particular question, answer that in details to see actually what the person who was asking tried to get to. So I did try to put up that. So maybe to go back, the living benefits, all the insurances we do offer at Freedom Equity Group, they all come with living benefits, meaning that you don't have to die to use the coverage that you have. What does that mean? Let me say, for example, if you happen to be critically ill, chronically ill, or terminally ill, you're not going to have to wait until you die for your beneficiaries to receive the money. But this policy is going to kick in as soon as your doctor says that you're critically ill, you can actually access your benefits. For example, let me say you took a policy. It could be a term, it could be index universal life, it could be a whole life. All our products do come with living benefits. So someone was asking for us to specifically actually tell them which conditions are covered under those policies, be term, whole life, or index universal life. So we wanted to show you exactly what is covered if any of the incidences of if you get sick, if you die too soon, or if you live a long life. So the living benefits are just actually as they show here. If you have a critical, that means you have a heart attack, a stroke, cancer, any of the major illnesses, like major organ transplant, any major, like you're actually blind, you're not able to see, you have paralysis, you are able to access up to or over 90% of your policy. Let me say, for example, you have $1 million policy in there and you happen to be critically ill. You can access up to 90%, depending on the severity of your illness. Actually, it goes up to 100%, depending on how your doctor analyzes that and tells your insurance company what you have. And then when it comes to chronic illness, it's the same thing. If you cannot bathe yourself, dress yourself, you actually take yourself to the toilet, be able to eat by yourself, all those you can actually access your insurance money while you're living. That's why they call these insurances life insurance. You don't have to die to use. We are all maybe used to those coverages whereby you have to die and then your beneficiaries can access the money. Not anymore. That is where we tell our listeners, do your research. Before you pick a policy, make sure that you're not just you're not covering other people, but you're covering yourself as well. And then when it comes to terminal illnesses, as long as your doctor will say you have 12 months to live, some doctors will tell you if you have 18, 24 months to live, you access your money, you access your coverage, and then you take care of your business. If you have a home to pay, you pay it off. If you have kids in school, you put them in school. If you have anything you're doing with your check, you keep everything actually done. You don't have to suffer waiting for you to go before the money can be released. So as we all actually try to cover ourselves, let us get educated of which kind of policies we pick so that we can actually cover ourselves correctly. This is also the same thing with the chronic and the critical illness riders. It shows you all these illnesses or issues that you can be able to be covered for. It's not one thing. It's a lot of things out there. You can be actually able to access your money without having to wait. And all these for chronic, you can't bathe yourself, dress yourself again. All these you can be able to actually access your benefits. So many people are always like, hey, when I'm gone, I'm gone. Why should I actually have to waste my money? Okay, what if you're not gone, but you can't actually go to work? How are you going to pay your bills? How are you going to take care of yourself? Your finances are going to be gone when we're not able to work. The check is not going to be coming when you're not working. But if you have a life insurance with living benefits, that is going to actually replace your income. That is why they call it income replacement. You can't work, but you protected yourself. You planned for your future. You planned for your family. You don't have to suffer waiting for you to go before you can access it. So for some people who do maybe have like the policies at work, you know how those work. You only have it when you're there. When you're not there, you lose it. And plus, it only covers when you're gone. When you're sick, you have nothing to take out of it. So think twice. Do your research, educate yourself, and actually get a better protection for yourself. So another question here was actually, what is the purpose of insuring our children or juveniles, especially considering that they have no immediate financial responsibility? It looks like actually the person who sent this question knew what we were going to talk about. And that is why we always, before we pick a topic, we listen to our listeners. We actually go back, ask them what they want us to talk about. What are their reservations? Why are they not covering themselves or their children? And that is where our expert, our mother, our financial professional, Elizabeth NSHIMIYE, is going to come in here and show us why actually those children need to be covered. So I'll go ahead and stop sharing and give the floor to Elizabeth to take us through that question and actually give us a good view of why we need to do that to our young ones. Thank you and welcome, Beth.
Thank you so much, Immaculate. Hello, everyone.
Hello, everyone. Just bear with us. Technology can do its things, but yeah, we're all good. And thank you for coming again. Thank you for joining in. As Beth prepares her presentation, please jot all your questions, whatever you want to ask. We're going to have a Q&A at the end of the presentation. Don't feel shy. You can actually start putting your questions in the chat. So this is a family again. We come here to learn together, educate one another. Nobody is actually not learning here. So put all your questions together and be ready to share or actually share what you have with us as well. Thank you.
All right, I'm back. Thanks for being patient with me. I'm excited to share this topic with you guys because I really wish I had this information 15 years ago when my oldest child was born, because goodness Lord, yeah, you will know why I'm saying this. It would have been more beneficial, but we start where if you gain new information, you learn it and you use it, and also share so that others can not be in the same state as you are. I think I introduced myself already. My name is Elizabeth, and I'm a licensed financial professional. Okay, overview. Because we're going to talk about the importance of juvenile IUL, but in order for you to get a full comparison, I want to talk about all the savings vehicles that I know that are out there for children and compare them with the IUL. That way, when you do choose to invest or to save for your child, you have a full view of what's out there and the pros and cons of each one of them. I like being transparent so that people make informed decisions. So far, these are the ones that I know that are out there. Of course, the IUL, that's the one I'm going to be talking about. That's the product we have in our life insurance. It's Indexed Universal Life. It's an insurance policy that has a saving product embedded in it. And then there's the 529. That's the one most people know. That's the one I knew. As soon as my baby dropped, we opened one for her. And yeah, that's all I knew, but it wasn't the greatest, because right now, as I can tell you, I've been putting money in there since she was like 1 week old. And the money that's in there is still not enough to cover for her college. So I wish I knew this. You guys are lucky. And then there's the custodial accounts like the UTMA and the UGMA, and then the traditional savings accounts. What is an IUL? An IUL, like I said, or Immaculate said in the beginning, is a permanent life insurance with a savings component with it. It has cash value that grows based on the market index, like the S&P 500 and all those. It's also flexible. It has flexible premiums and death benefits. If you start out saying, oh, I can put 100, and then time gets hard, you can reduce it to 50 or whatever. Or if you get more money, you can say, okay, now I think I can increase, my funding to this IUL. And the other beauty of it is tax-free growth potential. Like that is like the best thing you could ever give yourself or give your child, the gift of being able to take out that money and not getting taxed off of it. Okay, what are the key benefits of the IUL? Like I said, tax-free growth. You get your cash value growing, tax deferred, because you're using the money that has been taxed already, so you're not gonna be taxed again off of it. Flexible access. This is your money. You can access it as a parent. Your child can access it for as a loan, tax-free, and you can fund their education, you can fund their first home, you can pay for their wedding, whatever you want. Like, that's the beauty of this thing. And it has a lifetime coverage. Man, what can beat that? If you're gonna live to be 100, you know you're covered. You're good to go right into like your adulthood, and the death benefits are permanent. Potential for higher return because it's tied into the market index without direct investment risk. You know, like your money grows when that market is doing really good, your money is doing really, really good. When the market goes down, you're not going to lose your money like somebody who's investing in the market directly. This product has an embedded, it has a bottom line where you still earn not as much as the market is going, but you're not losing money. So you're always earning and not losing money. So it's a safe investment for your child or yourself. Guaranteed minimum interest, that's what I was talking about. Like if the market crashes, you have a guaranteed protection. You still get some kind of interest on your money. Okay, now let's do the comparison. The 529 plan. Well, the 529 plan is tax advantage savings for education. The pros for it is it's also tax-free growth for education or higher contribution limits. The cons for it, penalties if not used for education. So like if your child decides they're not going to college, forget about it. You've lost your money, or like you're gonna be taxed heavily on it. You're gonna get a penalty for it. You can, I guess, pass it on to someone else, but what's that? You saved it for someone for specific for a specific use. So there's that limitation. IUL, like we said, is very flexible. You can use your fund for whatever you want to use it for. If your child is an entrepreneur, he wants to go to start a business, you can take that money, you can give it to him and like go start your business, you know. The cons, I'm honest and about everything. So yes, it has higher premiums, but because you're getting a good product, and higher is not like just comparing with the 529, which is very limited. But this gives you way more than what the 529 gives, because you don't even have life insurance with it. You're not covered for you don't have living benefits when you get sick. You don't have a whole life insurance for the entirety of your life, So yeah, the UTMAs and UGMAs accounts, I think we already talked about those. Those are accounts for minors with control handed over at adulthood. Like you set it up for your child, but they can't have access to it until like they're 18, 21, depending on how it's set up. They have no tax shelter for long-term growth because you have to pay as the income grows, you pay taxes on it. So if that compared with the IUL, it has no forced transfer of control at specific age, and it's also tax-free growth. The fees that are associated with insurance. Again, insurance, you have more embedded in this than the UTMA product. Because if the UTMA, after you hand over to the kids, they can squander everything, and that's gone. They have no insurance, and you probably have to buy insurance, or they have to buy insurance separately. That's more money. In this, everything is together. Okay. Traditional savings accounts. If you ask me, those are the worst. I mean, yeah, simply the no risk, simple access to funds, and the interest rate is really laughable. Seriously, they'll give you 0 point something. You have 10,000 in there, and it only grow $1. They'll give you $1 or less than $1, 25 cents of interest. Like, come on, when are you gonna make money? When are you gonna, they're gonna take your money and invest it and give you not even a fraction of what you put in it. So it's like lending someone money, a family member money, and yet their business. So yeah, that's a no-go for me. If you ask me, so if you're thinking about setting your child up, that's really the lowest of lowest way to go. IUL, compared to the IUL, of course, higher growth potential. Like I said, when the economy is doing really, really good, you're making really, really good. If it's down, you're not losing money. They have a bottom line where you can't make less than that amount during the bad times of the stock market. Tax advantages, like I said, lifelong benefits. So you cannot really compare that. Cons, it might be more complex, but that's why we have people like us, those who invited you, professionals in this field. They worked hard, they did the exams, they passed, they studied, they invested in this so they can pass on the knowledge and help you secure the bag for your children. So, and yourself. So that's like a no, it's not a big deal because you have someone really holding your hand and guiding you through the whole entire thing. Okay. When to choose an IUL? If you ask me, if you have long-term planning for education, retirement, or financial security, like who doesn't? Parents seeking insurance coverage for a child along with their savings plan. I know us as a culture, we hate talking about death. We hate talking about misfortune because we think, oh, if I talk about it, it's gonna happen, Oh, but these things happen. Being ready helps you, avoid any mishaps or trying to rely on the goodness of people to help you. But like Immaculate said, you might not even die, your child might not even die, but they might, God forbid, and I'm not wishing this on anybody's child, but things happen. They can be crippled, they can get an illness. And if if we can really think about it, most of us immigrants, Africans, we don't know what diseases are in our DNA. We don't know. If they ask you what killed your grandpa, you don't know. Maybe it was diabetes, maybe it was heart attack. We don't know. But if you secure your child and help them have a life insurance that will grow with them, and it's fixed, they don't have to keep paying more or get checked. As we get older, we get diseases, so you're securing their insurability, and you're also helping them get a head start. Can you imagine if our parents knew this as first generation Americans? If they knew this, we wouldn't be carrying this much student loan debt on us. Some of us who are still paying that. But we have a privilege to do better for our children, and I hope we can do better. Really, it's nothing. It's money that you would spend on a birthday gift, which they're gonna play with, a toy that they're gonna play with for 1 week maximum, and they don't know where it is. It's stuck in the basement somewhere. Or you taking your children to McDonald's and you spend $200 or $100. McDonald's is expensive these days too. $100 on it. If you put it away every month for them, your child will retire a millionaire. Yeah, how would you save that much money for them? Okay, families wanting flexible access to their cash value of for various life needs, and it's your insurance policy. You insured your child, you still have access to it. If life happens in between, you have access to that money. You can take it out, yeah, it doesn't get better than that. Final thoughts, IUL is a flexible long-term saving strategy with insurance benefits. It's ideal for families looking for growth, tax advantages, and life insurance. Compare all juvenile saving plans based on your child's future needs. And I'm pretty sure we all know we want to make sure our children are financially stable in the future. We want to make sure our children can be insured. We want to make sure that our children can be well taken care of in case they get an illness. So I don't know who doesn't want that for their child, but still, the ball is in your court. You can choose as a saving plan based on your family's needs. Let's secure our children's financial freedom. Thank you so much for coming. Maybe, I think, Maki, what do you think? Maybe we can do like an illustration to show maybe how much your child could get, the potential earnings they can get within a policy, an IUL policy. Maybe that would give them a visual, right?
Yes.
Okay, you want to do that?
Yes, thank you. Thank you so much, Beth. That was really, really good. Every time we come here, it's not just maybe the guests who are coming in, but even us, we learn as we go all the time. So who doesn't learn every day? Like Beth was saying, we could wish we could have had these policies, but it's never too late. We didn't have them, but now we know. So our children don't have to go through the same hassle we're going through, which is good. And plus, like Beth was saying, you find like parents nowadays, you're talking to them, they're like, why? Why can't you get insured? Why can't you insure your child? Even, leave alone even the children though, even the adults. What is stopping people from being insured? What is it? Because we insure everything. What is your car worth? What is your home worth? If you really compare, like the comparison Elizabeth was showing us, if you compare the worth of your car, the worth of your home, the worth of everything that you own that is insured, is it worth than your life? To this point, is it worth than your children's lives? Because at the end of the day, everything that we really insure, they might matter to you at this moment, but the moment you get sick, live alone, dying, and you can't go to work, you're going to lose everything. Take, for example, you have a home, a brand new home, very beautiful, like really elegant right there. You're enjoying it because you're able to work and you pay the mortgage. Unless you had some money right there and you pay it off. But even if you pay it off, for some people, so for people who have homes really, it's not just the cost of mortgage that you have to do. You pay everything else. But the moment your check is gone and you're sick, guess what? That beautiful home is going to be gone. But if you can actually take a responsibility ahead of time, instead of thinking about insuring your home and your car, insure the source of everything. The source of your home is yourself, your life, you being able to go to work, you being able to earn, you being able to save, made you be able to actually afford that beautiful home, that beautiful car. All the vacations you go to is because you're alive, you're healthy, and you're able to go to work. So we keep repeating this. Really, we'll never get tired of talking about it. It is a crusade that we are on because why we keep saying it is because we see the same cycles happening over and over in our communities. If someone gets sick today, we go through GoFundMe. Someone dies tomorrow, we go through GoFundMe. Guess what? Yes, we have a beautiful culture of supporting one another. We're going to support when someone goes because that's our culture. It's good and it's beautiful. But guess what? Nobody's going to come back and take care of your family. Nobody is going to come back and take care of your mortgage. So let's think. We are a community of people who are hard workers immigrants mostly. We might have other people who are not migrants, but let me tell you, this country is a land of opportunities for people who are actually very serious about knowing how to take care of their finances. Because you make one mistake, it will cost you everything. So yes, we'll go through the illustration because it is beautiful to talk about it, but it's also better when you actually look at how those numbers work. Let me know if you can see my screen, then I'll go ahead and give me a thumbs up if you can see that. I'll go ahead and learn. Elizabeth, you can tell me maybe a child, at what age do you want me to learn? So I can go ahead and do that so we can.
I guess we can do like maybe one for like a newborn, like maybe a 1 year old, and then we do like a 10, a 15, you know, so they can get a clear view from what age group. A little bit of, if we have time.
Yes, ma'am.
Or we can ask. What age group do you guys want to look at?
No, that's good. That what you said is good. Like newborn, and then we'll go up to 10.
Okay, let's do that then. So let's pick a 1-year-old female from Texas. We've been talking about the index universal life. That is what we're going to go through because, of course, we do have different kind of life insurances. But as Beth was showing us, this actually seemed to be the best for our children. So let's do that. We're going to go ahead and learn an illustration for them. We do have different products, but as for now, gold product is the one that actually we do give our juveniles. Anybody 18 and below, and 18 and below, they will be the policy holders, but the parents or grandparents or whoever takes the policy is going to be the policy owner. Of which, as Beth was saying, you can actually sell for your child and actually access the funds. Okay, so let's say maybe if you're planning, we usually tell our parents or our clients to pick how much you're going to put for the child or even an adult. We do what we call a needs analysis. Why are you actually taking the policy? What is the purpose of you actually taking the policy? Are you trying to save for your children's education? If this child is 1, how much do you think you can put aside to be able to give actually that young lady, Jane, enough money to take them to college? Or if it's not for college, you want to buy them their first home or even a down payment. How much are you able to put down for that young child? Let me say, for example, you said you want to put down maybe $200 a month. You're saying instead of buying little stuff for the child, let me actually give them a head start with $200 a month. That is an example. Every family's financial need is different, and every family is going to pick how much they want to take for themselves or their children, depending on their need. So if we said $200 a month, that is going to be $2,400 a year. We want to show you how that money is going to grow for your child when they retire or even when they go to college. I believe Beth was saying, did mention that with IUL, Indexed Universal Life Insurance, when you pick it for yourself or your child, you covered for 120 years. The good thing we don't know anybody who has gone beyond 120, but in actual sense, you covered for life. So remember that. And you don't even have to pay for life, but you are covered for life. So we'll just run a quick example here because do that. We do have a lot of, so again, as we were saying from the beginning, if you have someone who did invite you, please reach out to them. Because when we do educate people here, we don't go like specifically like any person would have wished. So reach out to someone who invited you so they can give you actually thorough explanation depending on. So go ahead and learn that just to show you the numbers. But for the purposes of actually, if someone needs a personal illustration, we'll be here to help, or you can put in the chat and give us the real numbers you want. We'll be able to learn that for you. Just want to show you briefly how these numbers really beautifully generate compared with the money you put in your market. So let's say, for example, you have 1-year-old you want to put them at $200 a month. Remember, the Index Universal Life has two components, as Beth was explaining. It has the protection part, which is life insurance, which is that, the face amount. If you're putting $200 a month, starting from today, you're insuring your child with $1 million policy for life. Remember, when you start a child at 1 year old, you're locking in their age, you're locking in their premiums will never change, you're locking in their health. If they get sick at year 5, that is none of your business. If they grow up and they are 70, this $200 is not going to change. Later, we can learn a different illustration for someone who is 30. You see how much they pay when they are actually 30 to get $1 million policy. So what Beth was explaining, actually doing a head start for your child, you start them early, you save more for them for less. So let's look at this young lady. If you wanted to say, maybe, that's what I was saying, if you want to make sure that this child is going to college with enough money, you have to put a little more money. For people who have been using 529, you know how much you have to put in to generate enough income for your child to go to college. So don't feel like you can put $50. It is good. That can be a good investment. Actually, it can be good for their protection, but not their accumulation, not for their education. Because depending on how much you put on side, it will depend on how much your child is going to be able to take out when they grow up. But let's look maybe for the purposes of numbers. Like Beth was telling you, you put your money in your savings account. How much do you really get? Today, we all know, current today, that is as of today on the market, our index is on 7.13. That is what you earn. I'll show you on the comparison 20 years back how the market was performing. For example, the people I was able to give policies back in 2020 to like 2021, when we look at the Morgan Stanley, the one I'm giving you today, it was 19%, 16%, 19%. When you went through COVID, the height of COVID, the Morgan Stanley was minus 17.70%. But like Beth was telling you, what the client got was 0.25, not a negative. A 0 is better than negative. 0.25 is better than what we earn in our savings account. But today, it says 7.13%, meaning that if tomorrow the market was to jump back to 20%, like it was in 2023, your savings actually is going to be a double. So for example, let me say this young lady is paying $200 a month, $2,400 a year. This is what they are paying a year, but the 200 is actually not the cost of $1 million. Remember, they have the accumulation and they have also the protection. So there is, to see the real cost of $1 million for the protection, you're going to have 2,400, you take out 1,700. This column is the accumulation. You paid in 2,400, your child, year 1, they are able to save $1,798. Tell me, all of us, we do have savings account. How much do you think you will be able to earn on a $2,400 per year if you put in your savings account? Not even $5. If you're lucky, you get $5. This young lady is getting $1,798, almost getting back everything. If we can do the math really quick on your end as well, take out to see the cost of that insurance, 2,400, you take out 1,798. So the remaining balance for the year is 602. You divide by 12. This young lady is paying only $50 for $1 million protection. Please do us a favor and mute your phone if you're not talking. Okay, thank you. Okay, so I was still telling you, if this young lady is paying $2,400 a year and she's getting $1,798 back into her savings account, This is her savings account, the cash accumulation. They accumulate every single year, like Beth was telling you. You're killing two birds with one stone. You're paying in $200, your child is protected with $1 million policy for life, and she's earning all the money back into her savings account. Let us, for example, maybe jump and say like, hey, how much is my child is gonna have? And remember, this child is covered for 120 years, but we chose her to pay for only 40 years. By 41, she's done paying, right? She only paid 96,000. Guess what? By the time she stopped paying at 41, she already has the account value of 403,479. She only paid 96,000. You do the math and tell me how much that is. If you want to see how much this lady is going to be when she retires, at 65 when she retires, and remember, she's no longer contributing. You can even get 96,000, put it down, pay off the whole policy for your child. That is why they call them million dollar baby policies. This young lady, you only paid 96,000. She's going to retire at 65. She's going to have 2.1 million in there in cash. Tell me why this is not beautiful. Tell me why this is not a generational income. Well, actually, you're actually putting your child up. If this child retires with almost actually 2 million, why is she not going to actually open up accounts for your grandchildren? Tell me why. And plus, she still has $1 million protection for herself, meaning that if this lady is lucky enough to never ever be sick, she's not going to use the living benefits. Remember, we have the chronic illness, terminal illness, critical illness, free of charge that comes with the policy. If she was ever to get sick, she can access tax-free $1 million policy while she's living, but sick, because we don't know what holds our future holds. We are healthy today, our children are healthy, but we don't know in 50 years what is going to happen. That is why we see people who are smart savers, by the time they retire, they are traveling the world. Their children are millionaires. They're not even wanting to go to work. Why? They set them up right. I believe every parent, if we are intentional to know actually the best way to save for our children, all of them are going to actually retire millionaires, because I know we can afford this. We do spend our monies in so many ways that are not actually really beneficial. For those ones with teenagers like myself, a child will go out and buy a sneaker for $400. That is a 2-month premium right there. They are doing it because they're not educated. If you educate these young children, the whole generation, the future generation is going to be educated. Trust me. If this young lady, Jenny Mutoni, was able to retire with 2 million there, trust me, the whole generation is not gonna actually stay back. So this is how actually the elite, people who are aware how money works, they no longer put money in a savings account. Think about it. We all have savings account. What do we earn? We actually help the banks to make money. We don't earn anything from those banks. We give them money to actually make money. All these big banks, the Bank of America, the JP, whatever, the Chase, they all put their policies in IULs. They earn all the money they earn. They give you the residues. Why can't you do that? When it comes to our children, we can actually do anything. And like I was saying, this young child, the mom or the dad decided to put $200. Imagine if you put 500, what will happen? Like we said, it all depends on a financial need for the family, how much you can afford. There is no limit to how much you can put, but there is no maximum. Nobody will tell you, hey, you have to put $500. No. I do have parents who start off with $50, $100, but do something. Something is better than nothing, because guess what? All the beautiful things you're giving to that child, if you're not saving for them, you're actually setting them up for failure. That is pretty much it. This young lady put in 96, she's covered until 120. Look at that. Nobody goes there, but at least let's say She goes up to 91, she has 12 million in cash. She goes to 80, she has 6 million. She goes to 70, she has 3 million. And remember, all this is on assumption that the interest rate stays on 7.13, and that's not possible because we're not going to stay in recession. Like I was showing you, if we look at that comparison again, we always have numbers beyond 10. The only time we have, like in 2022, we had 0.25 because that was the height of COVID. Again, 2018, the rest is like 20, 17, 20, 22, 32. Imagine that. So these numbers are likely to actually triple. This is just a quotation that is done now. If the numbers change tomorrow, all these numbers you see here are going to triple or become actually more than a triple. So let me know. I'll go ahead and stop sharing here, and then I'll show you one page here. When we talk about the living benefits, the ones actually someone was asking from the beginning, that which living benefits are covered. Imagine if you have this protection right here and yourself. Let's not just talk about the child. The child gets a critical illness. It's telling you right here, this rider gives a policy owner access to 100% of the death benefit of the policy in which the rider is attached, or $1 million policy. In this case, this young lady took in $1 million policy. If they get a critical illness, they will 100% access $1 million protection. That is a living benefit because they are living. If they get a terminal, it's the same thing. So, like I was saying, we tend to give 100% protection on our homes and our cars. Let us rethink what we do. What is important? Our cars, our homes, or our children and our future. So let's think about that. Let me jump. It looks like we have questions in the chat. Unless there's something anybody wants to ask here before I actually leave. I'm not able to see the chat where this is open. I'll stop sharing so we can actually see if there's questions in the chat. Yes, you're right, Elizabeth. We get what they call compounding interest. You earn interest on interest. What you put in earns interest. Even the interest you earned also earns interest. For those who understand those compounding interest, that's how it works. Cash value keeps growing, yes. Yes, Jane. Even when you start paying, the cash value keeps growing because, again, you're earning on your compounding interest. I'm trying to see if we have questions in there. No, unfortunately, Judy. So people out of the US, as of now, the company is still negotiating to see whether we can give policies to people out of the country. But because of the regulations life insurance has at the moment, our company is yet to offer policies out of the country. Unfortunately, it would have been good for our people as well.
Yes, I said yes because not from us, but wherever they are, I'm pretty sure there are some insurance companies that offer IUL.
Yes, that is correct. And Brestia is saying, what is the best policy would you recommend to secure my child with? Beth, I think you can take that on.
As we saw from the comparisons I was giving you, definitely, I'm not gonna choose for you, but definitely, if to me, the IUL makes so much sense. Nothing makes better sense than making sure you have a cash accumulation for retirement or for whatever life throws at you in between. You have a policy that's protecting you. You have living benefits in case you get sick. Nothing beats that. I think it's a no-brainer to me. Like, that's the best way to go.
Thank you. The mic is open for Q&A. Please ask your questions, raise your hand and ask your question, or you can actually type in the chat as well. We'll really do our best to answer everything. We come here to learn, not just to lecture. So, and we love it when actually these sessions are interactive. That is when we all learn together. Please open your mic. Okay, thank you. Someone is saying, who is the beneficiary of the child? Yes, Donna. So remember, the child is always going to be the policy holder, but the parent or the grandparents are the policy owners. So yes, the beneficiary is going to be the parents or the grandparents. Whoever took in the policy is going to be the beneficiary. Actually, the parents can choose to put the beneficiaries as the siblings as well. Whichever you choose as the policy owner, you can put either the siblings or yourself as the beneficiary. Until the child is old, of course. If they're older and they get their own families, you're going to actually to move everything to the child when they turn 18, so they can choose their own beneficiary the way they see fit. That was a good one. Thank you. Someone else, please open your mic and ask. So like I was actually seeing someone was typing on my side saying that sometimes parents are actually scared to take policies because they don't want to feel that my child can die. Remember, the same way Beth was telling us, Lily, when you take on this policy, don't look at it as a death protection. Why do you think these policies are called life insurance? They are never called death insurance. The life insurance are for the living. Remember, the same way you cover your home, you don't want to burn it tonight. The same way you cover your car, you don't want to crash it tomorrow. So the life insurance, the good thing, is no longer the traditional one, whereby you have to die to use. You're actually saving for the future. You're actually going ahead of yourself, saying that what if? The life's what ifs. What if I get sick today? What if I die tomorrow? What if I get old and I have nothing to actually grow old with? Because you don't want to get old and you have no savings for you to live on. Start begging from your children and your grandchildren. You want to actually start saving now for the better of your tomorrow. Anybody with a question? It doesn't have to be a question. You can actually be adding something from what we have been discussing. You can ask in any question in any language as well. Whichever language you want, open your mic and ask. And if everything's good, we'll be happy.
Do you speak French?
Oh, I do have people who speak French, they can help. Go ahead, Mr. Kaizi.
Hi, can you hear me? Thank you, Miss IMMACULATE. Thank you, Miss Elizabeth. Very good information here. I was always wondering why the banks have all these beautiful buildings, the best lobbies, and this is why they know how these markets operate. So they get the money from the people and they go ahead and invest it in these markets. So we wonder why not everybody's doing this. And this is why you are in a good space to be able to educate us and everybody about this. Additionally, about the education fund through the IUL, it does help to avoid you being when when your child is going to college and they have an IUL, they are not able to be on the radar of the government, because if they're being given scholarships, then they won't be secluded, because the 529 is a state plan and that is viewable. It's one of the things that is asked. You have a 529 and then that is added onto your income, which secludes you getting all those scholarships and getting all the good benefits. And that's something I did run into, having had an IUL, a juvenile IUL for my son. So that's also information that should be shared. So for somebody who was asking about the 529 and comparisons, that is one of the big benefits that the Juvenile Universal Fund has. Thank you all for the information.
Oh, thank you so much, Mr. Kais. That was actually good. We all come here to learn. Most of us here have young children who are yet to go to college. So we learn a lot because we may think that we have those beautiful savings somewhere, but actually it's going to be a block, like a roadblock for you, because you might not have enough in the fund, but even getting scholarships is going to be a problem because they see you as having a lot of money. Why not putting it in a fund or in an account that is not going to be actually disadvantageous to you when your child is ready to go to college? That is good. Thank you, Mr. Kaizi. Someone else? Parents? Okay. Someone is asking, unfortunately saying my iPad, so I don't know who is asking. Someone is asking, is the policy and its benefits effective immediately after purchase? Yes, sir or ma'am, whoever it is, the moment you buy your policy today, let me say, and the good thing is, that's Dorothy. Thank you, Dorothy. Thank you for the question. So actually, as of recent, all the juvenile processes are actually approved right away. They are called instant approval. The moment you put it in, it is approved right away. So the moment your first payment is taken and they tell you your policy is active, everything is active. Yes, the benefits are active. Whether the child gets sick, you actually access everything. Everything is active the same day the policy is effective. The same day, the same way you buy your car insurance from Geico, from Allstate, they tell you your effective day is September 15th. It is the same thing with your policy here. Nothing changes. Thank you. That was beautiful. Someone else, we'll give it just extra 5 minutes or less, and then we'll go ahead and close just to be mindful of everybody's time. So if you have something, please put it out. You can put it in the chat or raise your hand. Otherwise, I will thank you for coming. We'll give you 2 minutes. 2 minutes.
I want to thank you, Ima and Elizabeth, for your good presentation about juvenile. I want to let every parent who is here, don't think that life insurance for our kids or for us, it's for this. Let us think it's like saving our future for our kids. You can try to buy a house for your kids. Every parent is struggling about the kids. When we have kids, when we have children, we always work hard, provide everything they need. But life insurance is saving their future. No, don't think it's for this benefits. The money that your kids will eat, the money when you die or they die. No, it's for their future. They will take that money anytime they need. It's for saving. It's like opening the account for them in life insurance because the bank doesn't provide enough cash value or profit for kids. But in life insurance, it grows. When the kids go to school, they can use it. It's like a will you can give your kids. Ni nk'umurage, sinzi ku buryo nabisobanura neza mu Cyongereza, ariko ni nk'umurage waho umwana wawe kurusha uko wamugurira inzu ukayishyira hariya, kurusha uko wafungura konte idakura. Saving account murabizi ko baduhaho nta kintu baduha, ushobora kuyabikana nyuma y'imyaka 20 umwana yazakura agasanga ni bya bihumbi 10 wasizeyo. Ariko hano muri IUL nk'uko babitubwiye, ubonye umwana w'umwaka umwe nyuma y'imyaka 10 amafaranga aba amaze kurenga wowe wamuteganyirije. So ababyeyi twese dukorera abana. Iyo maze kugira umwana niwe ubutekereza ko yagira future iruti yawe wowe wagize. So ibi ngibi mbona ari nk'umuti, ni nka ikintu twaraga abana bacu nabo bakazaraga babo, kuko nta kindi wamuha cyaramba kandi cyunguka. So thank you. I understand it. I wish everyone can understand how I understand it. Ahubwo nje nkaba mvuga nti nkatwe tutagifite uwo mwana w'umwaka umwe abacu bari muri teenagers 10 bari muri 20 bari muri 22. We are very late. I don't know if we can put more money kandi tutayifite cyangwa se twabigenza gute. Where can we start in fact?
Oh, thank you so much, Jen. That was good. We told everybody to speak the language they actually feel comfortable, because we are here to learn. Don't feel actually shy, because this is actually real. It hits hard. We were saying with the Beth that we wish we knew when we came in this country 23 years ago, 25 years ago. It would have been amazing, but it's never too late. Start where you are. It might not be as cheap as a 1-year-old, but it's still cheaper than a 40-year-old. So actually, if you have teenagers, start now. It's not too bad. As long as it's still, even the 45, 50 get their policies, so start now. They might not use the money for college, but they will use the money for the future. So it's never too late. Thank you. That was beautiful. Thank you. The translation actually was, Jen was actually saying that the IUR is very beautiful, it's good. At the end, she was saying that for parents who are no longer with the children 1 year to maybe 5-10 years, they have teenagers, is that too late? What can they do? I was also saying that it's never too late. Teenagers is not as too expensive actually. The difference is not too much, because the 1-year-old actually is considered riskier than a 10-year-old. So teenagers, you're still in good hands. Even 20s, you're still good. Up to 50, 55, you can still get your insurance as much as you want. Remember, you take what you can afford. Never pick something you won't be able to chew. People will tell you, take $1 million, be a millionaire tomorrow. But remember, that is a payment that you're going to pay for 30, 40 years. So sit with someone who invited you, the professional, to learn your needs analysis, to see what you need. Don't pick something because someone picked something. Let someone do a needs analysis for you to see whether what you pick actually is going to be beneficial for you and your family. So if nobody has, Elizabeth, you have something else to say before we can close? Beth, you're on mute.
No, yeah, I'd just like to thank everyone for coming and for contributing. I hope this was helpful. And if you have further questions, you can reach out to me, IMMACULATE, or any other financial professional you're working with currently. Yes, like she said, start where you are. Like I was saying, I didn't know about this until recently, like last year. And that's when I started, and it still looks good compared, if I was to put it in any other account, it wouldn't be accruing what it's accruing right now. So, or what they would be getting 10 years from now or 20 years from now. Oh, maybe one other thing that maybe we might have missed to say, you don't have to continue paying for it until the child is all the way grown until they're 40. You can pass it back to them. Like once they finish school, you can hand them their policy and they continue from there until like they feel like it's in a good place where they can stop funding it. So yeah, that's the one other piece we forgot to mention. Don't feel like you're stuck paying this $100, $50, or $200 for the rest of your life. You can fund it to whenever you're comfortable. It's a gift, even if you fund it for, let's say, 15 years, they'll have made about what? Over 400,000 or more, still a good gift you've given them. And then they can continue from there, because by then they'll have finished college, they have jobs, they can carry their policy. And if they fall on hard times, they have a grace period. Their accumulated cash can fund their policy for a certain period. So don't feel like, oh, and that's the good thing about this. You can't lose money either way. This policy, you can't lose money. That's the beauty of it. So go sleep on it, think about it, reach out if you have any further questions. And we love you for coming, for giving us your time. Thank you so much.
Yes, thank you, thank you, thank you, everyone. Remember, this is a recurring actually training we have every Thursday evening. Some days we switch to Kinyarwanda, some days we do English, so our people can be able to actually learn comfortably. But we thank you, as Beth said, we thank you for your time. We understand time here is money, but we are here to learn about money again. And thank you so much for tuning in, and I'll sure share the recording for those who missed out, or if you came in a little late, we'll share the recording so you can be able to keep educating yourself and share with your friends as well. Have a great night, everyone, and thank you.